afternoon, and thank you all for joining us for our first presentation in a new series on personal financial planning. I'm Sebrina Ivey, the Chief Operating Officer and Wealth Advisor for GHP Investment Advisors. For those of you who have worked with GHPIA in the past, our financial planning puzzle may already be familiar. In considering our clients' financial pictures, we break the process into 6 main components: retirement planning, education planning, risk management or insurance review, income tax planning, estate planning, and finally, investment management. We base each of our clients' investment portfolios on their personalized needs based on an assessment of a variety of issues that touch each of these puzzle pieces. While we won't talk about every element of the puzzle today, we will touch on some areas that have been impacted by changes and trends this year. First, Reed will talk to us regarding risk management.
Great. Thanks, Sabrina. So for those of you that don't know me, my name is Reed McCoy, another advisor here at GHP, about 9 years here, 14 in the industry. So we sometimes call this puzzle piece the insurance review. I'm broadening it today because a lot of risks that we're managing are often insurable, but really what we're talking about today is the managing the rising cost of healthcare, and that's more of a systemic risk. So we're not going to necessarily just focus on insurance, but other ways that we might manage our expectations and other things that we can do to maybe mitigate or manage that risk. So when I bring up the concept of the rising cost of healthcare, that's not something that generally is a surprising term or concept for most people. We all have been experiencing it by way of premium increases or just when we go to the doctor or pick up prescriptions. So that's not so surprising. What is surprising is when we generally start talking about the increase that we're experiencing compared to the increase that's actually happening somewhat behind the scenes by way of the government's share of that inflation. And so what we've seen here is for the last 35 years, us as households, businesses, our expenditures have been rising faster than inflation, general inflation, and faster than GDP at a rate of roughly about 5% per year. Meanwhile, the state and local government's share of health expenditures has been increasing at about 6%, so a bit faster, and the federal expenses have been increasing by almost 8% per year. So what that has led to is effectively, up until the year 2000, the government's share of total expenditures was about 25 to 30%. Since the year 2000, that has ballooned, and now we're looking at the total government share being roughly half of every dollar spent on healthcare. So it's no surprise a big part of that has been by way of Medicare and Medicaid and those expanding programs. So especially over the last 15 years, we've seen effectively a doubling of the total expenses on those two programs. We're now at a situation where Medicaid, 1 in 4 people in the population, in some states, it's 1 out of every 3 are on Medicaid. And Medicare, obviously, with some of the demographic trends and baby boomers retiring, we've seen more people enrolling in Medicare and the underlying expenses also increasing. That trend obviously likely to continue. So that in and of itself isn't necessarily a problem. There's a lot of systems around the world where the government is the primary funder or provider of care. The problem is that here in the US, we're spending, in some instances, about 7 times more than other developed countries on our healthcare system. And so what the government is actually doing is funding a lot of that growth in their expenses by way of debt. And so we're now, especially since the great financial crisis and the COVID era, where we've taken on quite a bit of additional debt for those stimulus programs, we're reaching a point where the net interest that we're spending just to service that debt is approaching about what we spend on Medicare on an annual basis. It's already exceeded what we spend on defense. So that's not forecasted to slow down or change. So we find ourselves in a situation where there's a bit of a collision course with our fiscal situation. Something's got to give. So we know from precedent that generally it's not going to be a solution. There are no perfect solutions, but whatever that looks like in the future, whatever changes will happen will likely be some form of these 3 elements, which is raising taxes, lowering spending, and hopefully achieving some cost efficiencies and productivity. So if we look at each of those and we kind of do a study on what has happened in the past to inform what maybe to expect in the future, typically tax raises come by way of gradual increases in the tax code, and it typically affects the younger generations more so as it gets rolled out, and we see those increases. So it's unlikely that barring some unprecedented event, that we're going to see some huge change to the tax code that increases significantly for one part of the population or one area. Certainly, it's possible, but a little less precedented. From the spending aspect, of course, if you're targeting any budget cuts, you're going to be looking at some of the biggest culprits or the biggest spending line items. And so, of course, Medicare, Medicaid, Social Security, defense, all of these are potential places to be looking. What we also do kind of rely on here is precedent where it's unlikely to see that the government is going to decrease Social Security or Medicare, or some of these really popular benefits for people. It's probably more likely that any changes to those are going to be slow and gradual as opposed to abrupt. And it's more likely also that there could be offsets there with revenue raising instead of just cutting those benefits. And then ultimately, we're hoping that there's some productivity gains. The U.S. tends to be pretty good at finding ways to become more efficient. But ultimately, technology and all those types of efficiencies, they take time, and the healthcare system is a big one, and it's entrenched, and so it's very slow moving. So we wouldn't expect any major changes, even in the age of AI, for that to happen overnight. And then also, healthcare is largely a service business, so there's always going to be some labor-related restraints on supply that will have to be dealt with. So all of that's kind of worth considering when setting expectations. And so what to expect. So if we look at kind of different phases of life, right, and we start with the early career, setting expectations for those in their early career, I think starts with just understanding that this is probably not going to be solved anytime soon, and costs are likely to continue to rise. So that will likely take the form of higher out-of-pocket expenses, deductibles, premiums, what have you. If taxes are raised, it may mean higher income taxes, more taken out of paychecks for FICA, or it could be fewer tax breaks on things like investment accounts, long-term capital gains, retirement accounts, what have you. And then ultimately, I think it's important for the younger generation to assume that any sort of benefits down the road, like Social Security benefits, will probably just not be as robust as they are today, at the very least. So things to then be that are more actionable from an early career phase. We like to explore all the tools available. The best tool really available at this point for saving specifically earmarked for health is going to be a health savings account, so HSAs. And so assuming that a high deductible health plan makes sense, we often will recommend that we start looking at HSAs not as a conduit or a flow through kind of bank account for ongoing expenses, but if it's affordable and you can pay for those expenses out of pocket, keeping that money preserved in an HSA for the long run and letting it invest and grow over time may be a really wise approach. One of the other pitfalls that we often see for the younger generation, some adult children of our clients frequently, is that they stay on their parents' health insurance until age 26 simply because they can. But often we find that that may not make sense. And that their employer, if they're new job out of college or whatever that may look like, it could be that their employer is covering a significant amount of the premium, or that if they go on their own insurance, that they'd be eligible for an HSA where they wouldn't necessarily if they're on their parents. They're not on a high deductible plan. So that's always something worth taking a look at and analyzing with us. HSAs obviously being one of the employer benefits more commonly offered now, but the whole package is important to be analyzing. So we really want to make sure that clients are using all of the FSAs, insurance options, and really optimizing those things. So that's something we really like to analyze with our clients. Beyond all of those, so checking off the list of kind of the tax advantaged accounts and employer benefits and retirement accounts, things like that, we really liked having a general purpose account for savings. So saving to something that is, outside of any sort of wrapper that is specific for health or specific to retirement can be a really great way to just defend against anything that's going to come your way, anything that may change. So, kind of the best way to defend oneself. And then finally, investing in yourself. So, early in your career, I think it's important just to always be prioritizing your own career, earnings potential, but also your own health. So, things that are preventable, health-related things that are preventable, start early. And I know that's not typical financial advice, but it's important. So, a lot of the things I just mentioned for early career also apply to mid-career. Some key differences, mid-career typically you are the highest earning years, also can be the highest spending years. So we find that especially if those in their mid-career are have kids and dependents on that side, or sometimes caring for a parent or other dependent in the family as well, that can really squeeze the budget a little bit. And that may not change. That may be that that's increasing. We've seen things like that, staying on in parents insurance until age 26. We're seeing that it's more and more common for the adult children of our clients to still need some financial support well into their 20s. That may be the case. So planning for that and just assuming that there might be an extended amount of coverage there is important. Also, one of the ways that it's likely to see increases in costs is what we have been seeing, which is that shared cost with the employer for premiums and for healthcare. So, those in their mid-career, if you are either an employee or often an employer, this obviously affects you. So, as an employer, continuing to put in the budget that there's going to be increases in cost related to health insurance for employees. As an employee, understanding that your total compensation may be going up, but it may feel like you're actually not keeping up with general inflation as much because it's the premiums that are really increasing, and your employer has to balance how much they can increase your total benefits package. So just being aware of that and what to expect. Also, we tend to find that this is kind of the phase where people maybe have decided to have one parent stay home, one parent be the primary breadwinner. In that case, it's ultra important to make sure that you're well covered for things like disability, life insurance. So really kind of checking in on those types of things with us is important. Uh, Likewise, for the early career phase, I think saving to HSAs and utilizing them is really important. But also, we find that often the younger generation, adult children, may not be completely maxing out their HSAs for whatever reason, and parents want to be gifting, or grandparents want to be gifting to them, and that can actually be another great way to kind of be checking two boxes at once, which is doing a little bit of gifting while doing it in a tax efficient way through an HSA. And then finally, so we really think it's important, and we love the fact that those, especially in the higher earning years where there's more excess savings capacity, to be generous and be saving to or wanting to gift to children or to charity. But ultimately, we want to make sure that making that the family and that you yourself are fortified against anything that may come your way. So really focusing on your own savings, and that could be a general purpose account, all these other accounts we've talked about, is really important, and first and foremost should be the priority before gifting and which can always happen later on down the road. So that doesn't need to always happen uh, right away. And then finally, so for those that are in their nearing retirement or in retirement, I think it helps to step back a little bit because we're maybe speculating a little bit on what may happen in the healthcare industry in the near term. And so if we actually study what other systems look like compared to ours, what we find is that typically there's a balance of priorities between cost, quality, and diversity of options. Generally, there's going to be focus on two of those at the cost of one of the others. Okay. Here in the US, we've very clearly chosen quality and option or diversity of options as kind of our priorities at the high cost that we've been experiencing. If it turns out that we have to start prioritizing cost a little bit more and controlling that on some level, then that would likely mean that we're going to be moving towards less diversity of options or less quality. Most people would probably agree that we don't want to sacrifice quality. So it may be reasonable to expect that we're going to have less diversity of options, or that if you're going to want to maintain those, both quality and diversity of options, that it may come at an even higher cost for you. So I think that just helps to kind of frame, what possibly to expect if our whole system tends to shift more towards the paradigms that we see in other places. So that might mean, any of the things you see here for higher costs or long-term care. From a planning and action standpoint, a lot of this is what we're doing when we're planning in financial modeling, which is really just being conservative with our assumptions. I think this is important to emphasize. We see sometimes people come in and have fall into the pitfall of thinking that they're going to spend less in retirement, when ultimately we often experience that they spend a little bit more right away in retirement, then things level out a little bit closer to what we saw prior to retirement, and then an even higher phase of spending, maybe because of health related things towards the end of life. So we want to make sure to account for that in our modeling. Also, as kind of a last resort, kind of in the worst case scenario, we always are going to model having that primary residence as the what we call kind of the asset of last resort. Basically, in case everything, you're in that small percentage of people where, unfortunately, you have, both spouses need a lot of long-term care, high cost long-term care. You always have that final asset to rely on. And then when it comes to long-term care, one of the things we really want to push is that people have the conversation. I know it's an uncomfortable one, but have it sooner than later. Of course, with your spouse on what your expectations are for home health care versus maybe independent living or assisted living, things like that. And then anyone else in the extended family that may be impacted by that. It's helpful to talk about it ahead of time, even though it's an uncomfortable conversation. And then last but not least, investing in yourself. Don't fall into the pitfall that it's too late for you to start healthy habits or to be developing those kinds of routines. Anything you can do to prevent the preventable is a good idea. So great. With that, I will pass it off to Sebrina to talk about the HR1 bill. Thank you.
Thank you, Reed. Now it's time to talk about something super exciting, taxes. The new legislation, HR1, which is also called the One Big Beautiful Bill Act, or OBBBA or OB3, introduces a mix of temporary and permanent changes that may impact your taxes and financial planning through every phase of life. Some of them are short-term, some are here to stay, but they're all worth understanding. As with any tax presentation, I will add a comment that you should talk to your personal tax advisor regarding the impact on your tax situation, as there are a lot of nuances to all of these rules. Here's a quick overview of what's changing, then we'll delve into a little bit more detail. The lower individual tax bracket from the Tax Cuts and Job Act are now permanent. There's a new deduction for seniors starting for 2025 through 2028. State and local income tax deduction cap is rising temporarily. We also have potential deductions for qualified tips, overtime, and interest for new car loan purchases available from 2025 to 2028. And finally, in this presentation, we'll review some permanent changes to the charitable giving deductions and how that's treated for the future. First off, potentially great news for seniors. Starting this year, 2025, we will have an additional deduction for taxpayers over age 65 of up to $6,000 per person, whether they itemize or take the standard deduction. But there's a phase out for single filers. The phase out starts at 75,000 of modified adjusted gross income, and it phases out completely by 175. For married couples, it's 150 and phases out by 250,000, but obviously only if both of the spouses are 65 or older. This is a temporary benefit available through 2028. But one significant thing to really note is that this deduction does not reduce the overall taxability of Social Security benefits. There was some initial word that it was going to have a direct impact. It can overall lower your tax bill by reducing the taxable income, but Social Security and the taxation of that is still calculated in the same way. Next, and first off, I'm sorry, because this is going to feel a little bit like a list I'm going through. The state and local tax deduction cap is getting a temporary boost. This is also called the SALT deduction. In 2025, it jumps from $10,000 to $40,000. For married filing separately, $20,000. And it also starts phasing out at $500,000 of modified adjusted gross income. By $600,000, it is back down to that $10,000 floor. This lasts until 2030 when it reverts back to the original $10,000 cap. The next few are some unique changes for 2025 to 2028. First, there is a new deduction on qualified tips of up to $25,000 per year. It applies to employees and self-employed individuals in occupations that regularly receive tips. The tips need to be reported on W-2, 1099, or Form 4137. The IRS is still working on updating the forms to track the difference in the tips. So to be a qualified tip, it must be voluntarily given by the customer, not negotiated, determined by the payor, paid in the form of cash, which can include credit cards or anything that's cash, but it can't be that we're tipping in cars or cats or anything like that. And it must be earned in a business where tipping was customary as of December 31st, 2024. Can't be in a specified trade or business, so check with your tax advisor if you're unsure if your tips are qualified. From 2024 to 2028, we also have a deduction potential on overtime compensation. The overtime is anything that is required by the Fair Labor Standards Act. So think about this as being time and a half, double time type pay. There is a deduction for up to $12,500 for single filers or $25,000. And again, there is a phase out for people with modified adjusted gross income of over $150,000 or $300,000 for joint filers. Another potential exciting one, for the tax years of 2025 to 2028, you might be able to deduct interest paid on loans used to purchase qualified vehicles. A qualified vehicle is a new car, minivan, van, SUV, pickup truck, or motorcycle with a gross vehicle weight rating of less than 14,000 pounds that has undergone final assembly in the United States. That's a direct quote, so it's a little hard to get through. The maximum deduction is $10,000 a year. And again, there's a phase out that begins at a $100,000 or $200,000 for joint filers. This is a really interesting one. There have been some significant changes for charitable giving starting in 2026. So there is made permanent is an above the line deduction for non-itemizers. $1,000 for single filers, $2,000 for joint filers. The above the line deduction is only for cash contributions, and it cannot use donor advised funds for those. Additionally, starting in 2026, we have a floor for charitable deductions for those who itemize their deductions. The floor is set at 0.5% of adjusted gross income. So for example, an adjusted gross income of $100,000 would mean any contributions above $500 would be deductible as an itemized deduction, but anything below that would be excluded. For those of you who are familiar with Schedule A, this is very similar to how the calculation is for medical expenses. Given this substantial change, you might want to consider making a larger charitable contribution to a donor advised fund in 2025 before the floors go into effect. I know we've been talking to a lot of clients about that option. And then one final note for HR 1 is that taxpayers in the highest tax bracket of 37% will be impacted by a new cap on the limit that limits the value of itemized deductions. So instead of getting the value of the full 37%, the value of your itemized deductions will be reduced to a 35% overall impact. I know that this has been a really dense presentation and just like I said, kind of a list of things that are going on. As I said earlier, your tax preparer will have more insight into the impact of your personal situation, but please feel free to reach out to your team at GHPIA for any questions, and particularly if we need to do anything before the end of 2025, be in touch soon. Now I'm going to introduce Barbara to talk about a lighter topic, estate planning.
Thanks, Sebrina. Hello, everyone. Good afternoon. My name is Barbara Terrazas, and I am a wealth advisor and CFP professional here at GHP. Today, like Sebrina said, I'm going to be reviewing how we at GHP Investment Advisors approach estate planning by walking through planning opportunities at each phase of adulthood. Following the review, I will wrap up with a discussion on what changes occurred as a result of the HR 1 bill, aka the One Big Beautiful Bill Act, signed into law this summer. So let's get started. First, when most people hear about estate planning, they usually think of the very old or the very wealthy. Additionally, most people attribute estate planning to post-career and retirement phases and generally push this towards the bottom of the priority list. I am here to tell you and remind you that planning is essential for all stages of adulthood. At its core, estate planning is about control. Who makes decisions for you, who inherits your assets, and how your loved ones are cared for at every stage of life. As you may or may not know, I am not, nor is anyone currently on staff at GHP Investment Advisors, an estate planning attorney. So our role is to work in concert with your estate planning attorney and tax professionals to develop and implement your estate plan. It is a coordinated effort between all of us. Additionally, estate law is different for each state. So having awareness and understanding of your state's probate and estate laws is important. Our team has extensive experience and a deep bench with estate planning for our clients. With over 1,200 clients, we have read many estate planning documents and navigated countless complex situations with our clients. We always advocate for simplicity when it comes to estate planning, but it's not always achievable when legacy, tax, and personal goals are competing. We also use quantitative and comprehensive financial modeling to help you understand where your wealth position is now and what it may look like over time. Estate planning requires a long-term focus to planning, in addition to planning for your current status. Now I'm going to shift into discussing key goals and essential documents and actions through different stages of adulthood, starting here with young adults. So estate planning at its earliest stages starts with responsibility and not always wealth. Estate planning for young adults should focus on protection and preparedness. The key goals for planning at this stage should be to establish simple estate planning documents, such as a will and financial powers of attorney, to prepare for emergencies. Once you or your child turns 18, parents can no longer make medical and financial decisions, so it's important to establish instructions early. At the next stage of early career in young families, the focus shifts to protecting loved ones, providing for dependents, and growing assets. Marriage, children, and property ownership at this stage make planning essential. Some items to consider are updating wills to add guardianship for minors, considering a revocable trust for privacy and probate avoidance, and reviewing beneficiaries for current bank and retirement accounts. As a reminder, individual beneficiary designations supersede a will. During peak earning years, the focus is generally on building and preserving your wealth with a focus on tax efficiency and transition planning. Estate planning is rarely a set it and forget it exercise, so we recommend reviewing documents every 3 to 5 years or after a big life event to ensure consistency. At this stage, it is also important to incorporate tax planning into your estate plan as your wealth grows. Trusts can be a useful tool in managing property and business interests as well and should be evaluated for appropriateness. Revisiting documents when children are no longer minors is important, as their roles within your estate plan may change. For example, they may be old enough now to take over personal representative, executor, or trustee roles. As you may notice, past actions that I've gone through in estate planning typically apply to multiple stages of adulthood, and even more so as you age. Routinely reviewing your documents should be a standard practice, as well as reviewing beneficiary designations. In the pre-retirement stage, you continue many of the steps from midlife while starting to focus on wealth transfer. Tax planning, again, is important. As your wealth continues to grow, it is also important to keep an eye on estate tax issues. Revisiting healthcare directives such as medical powers of attorney and organizing digital assets and passwords is just generally always a good idea. For retirees, simplifying and protecting your legacy is the key goal here. Review wills and trusts regularly and start the discussion with family members. In our experience, discussing your wishes with your family early allows for an easier transition. Additionally, tax planning continues to be at the forefront for those in taxable estate situations. Consider charitable and family giving strategies to minimize the estate tax impact. I also wanted to include some common mistakes that we've seen and to avoid when estate planning. These are all items that we have seen regularly, so it's a gentle reminder. First, failure to update documents after marriage, divorce, or death. We have seen it happen. It does get messy. Not coordinating beneficiary designations with your will or trust. Forgetting about digital assets, and then not considering state-specific estate or inheritance taxes. Finally, to wrap up this discussion, the One Big Beautiful Bill Act did contain provisions that affect estate planning. Specifically, the estate tax exemption was increased to $15 million per individual, effective January 1st, 2026. The tax rate for estate tax remains the same at 40%. And finally, there's a permanence to the exclusion, which eliminates the scheduled sunset. The sunset would have cut the estate tax exemption to around $5 million per person, adjusted for inflation. As a side note, permanence is in quotes or written in pencil, as I like to say, because as we know, nothing is ever permanent when it comes to the tax code, but we can safely say the 2026 sunset is no longer a concern. So, why do these changes matter? They matter because they now provide certainty for long-term planning. There are fewer use it or lose it pressures that we had with the impending 2026 sunset. Larger estates can transfer more wealth tax-free, and it allows for more flexible timing for gifts and trust funding. Like I said at the beginning of this discussion, we have extensive experience with estate planning for our clients and working with other professionals to help our clients plan. It is not always a fun subject to discuss. We get that, but it's still imperative and important to tackle. To wrap up fully, we've covered a lot of ground here today. We've discussed rising insurance costs, how to approach insurance and estate planning through every phase of life, and then the One Big Beautiful Bill Act changes. Each individual situation is different. Our experienced team is always here to answer questions or address concerns. Please reach out to our advisory and financial planning teams to get a detailed review on any of the subjects we covered today or to discuss our wealth management services. Reed, Sebrina, and I thank you for being here. Happy early Thanksgiving, and we hope you have a great rest of your day.
Also, when I add, we know it's hard for some people to attend midday. So we're going to be putting this on YouTube and sending it out. So if you found anything in here interesting, please forward it along to others that you think it might be helpful for. All right. Thanks, everybody.
Thanks.